Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Sorry, I know it's been a long time. I just kind of got out of it, but I want to jump back in. I miss recording the video. So today is Monday. We are sitting at $51,321.84. Of course, that's going to change because the markets are open. Not a huge deal. But for today, we are down about 140 bucks. For the week, we are up $167. For the 1 month mark, we're up $920. 3 month mark, we're up almost about $3,900, about 8.3%. Year to date, we are up around $1,500 or right around 3%. The 1 year mark, we're up about $600, up about 1.12%. And then all time, since around April of 2018, we are at $15,970.97, about a 45% return all time. I do have a buying power of $86, so I did just go through and buy shares of O, but I'll get to that in just a second. So, realty income, starting off the portfolio. Today it's at $52.50. We have 170 shares. I did get paid dividends last month, and I put that back into realty income because, as you guys can see, it is down pretty heavy right now, which is good. I love that it's down. It is down because of interest rates. I don't think that the business is struggling. They have a bunch of contracts that they just got in Las Vegas, and so they're getting cash flow from those properties, and they had a couple of really big acquisitions in the past year or two. So I'm not worried about cash flow. I think it's going to be stronger than ever. I think it's a little bit of an overreaction, and that's why I put my free cash into realty income. But as of right now, we have 170 shares. Market value is sitting around $8,900. Today, we're at $65.03 for our average cost. I did just lower that with those adding four shares over the weekend. 17.5% of the portfolio is in realty income. Today we're up around 42 bucks. Total we're down over 2,100, down almost 20% on this position. Like I said, I'm not super worried about it, just simply because I understand why the business is going down. I don't think there's anything fundamentally wrong with the company. As I said, they have acquired new real estate with the VREIT acquisition. And then they just did another one as well not too long ago. So they do have more cash flow coming in from those properties. And as another thing that I think helped strengthen the business was they spun out the office properties. So I think overall they acquired better tenants. They have a wider range of tenants as well, and I think that helps the diversification within the business. Getting more cash flow from different types of properties helps, as well as getting some more of those very high-grade tenants that they got in a couple of those acquisitions. It did build up some of their core positions like Dollar General. I know they got some Sam's Club in that deal. They got more Walgreens. They got Family Dollar and Dollar Tree as well. So they have added to their stronger tenants. And I think that's going to help with the cash flow overall. So I'm not worried about the stock being down. I think it is a great buying opportunity, as well as, like I said earlier, the interest rates. But that makes it harder for REITs to do acquisitions. So I understand why they tried to jump in and do it as quick as possible, because now when they try to do an acquisition, they're going to need a higher rate of return to break even on those interest rates. But as you guys know, it is a monthly dividend paying company. It's popular for that reason. They've increased the dividend for, I believe, 26 years now. So my dividend is sitting at, of course, 166 shares. That's what I'm getting paid for, because I just added those 4 shares, like I said, at the beginning of the weekend. So the dividend per share is 0.2565 cents per share. So my total amount I'm getting paid for now is $42.58, because, again, I purchased those shares after the X date, so they will not be added to my total payout. But now I'm getting paid around $43, so next month I'll be getting paid a little bit more. Then we've got Coca-Cola. I added it back. This is my favorite company. This and Apple are two of my absolute favorites, so I needed it back into the portfolio. And it is going to be one of my bigger positions, simply because I love the brand. I love the products. I drink it all the time, daily pretty much, whether it be Powerade, actual Coca-Cola products, Sprite. They have some coffees now. I love the business. This is one of those that, just like when Warren Buffett said when he was young, he used to go to his grandpa's store and he looked at the best-selling pops or sodas in the store, and the the most purchased was Coca-Cola, and he figured that out. The way he determined that was because he looked at all the soda that had been sold and counted the pop tabs that were on the ground. And so he figured out as a kid that Coca-Cola was sold more than anything else. So he went door to door selling bottles of Coca-Cola. And obviously he, built up a little bit. He had a pinball machine business, and then eventually he owned the stock. So just like the same mistake Warren Buffett made, I've been drinking Coca-Cola since I was a kid. My mom drank it when I was growing up, and it took me, 28 years to buy the stock. So the reason I love owning Coca-Cola is because every time I purchase that product, or I go to McDonald's or Culver's or a restaurant, odds are they sell Coca-Cola, most do. So anytime somebody orders a beverage at a restaurant, I'm getting paid. Every time somebody buys a carton or, buys merchandise or anything like that, I make money. And that's why I love the business. So in my brain, the way I look at it is I can either purchase Coca-Cola or I can own the vending machine as in owning the company. And that's what I would prefer to do, is just own the vending machine and own Coca-Cola. And even if it isn't a huge grower, I would prefer owning it over other companies because I understand the business intimately and I interact with it every single day. So as of right now, we have 15 shares, around $900 of market value. Average cost is right around $61 per share, so I could cost down average right now. 1.75% of the portfolio is in Coca-Cola. Today, we are up $5. Total, we're down $10, down 1.13%. Not worried about it. This is a slight buying opportunity, but my goal range for buying Coca-Cola would be around $52. So as of right now, it's below my average cost. So I wouldn't mind actually buying in right now, even though I think it's a little bit overvalued, just given the fact that it's going to lower my average cost. And I want to own more Coca-Cola, as it is one of my favorite positions and favorite companies in the entire world. Next, we've got Altria. Now, this one is down pretty big as well. This is my single biggest position, I believe, still in the portfolio. It's hard to know with market fluctuation, but we have 320 shares, about $12,700 of market value. Average cost is $47.27, so a massive loss on this company. Not a huge deal, though. 25% of the portfolio is in Altria. Today, we're down $300. Total, we're down around $2,400, down 16%. On Altria. And so the reason I'm not worried about this is it pays an ever-growing dividend. The profits are going down, but they have pricing power, so they can increase the prices. The other huge issue with this company is smoking rates have been declining for decades. And they understand that, so they're trying to diversify the business. And a couple of those attempts to diversify have not gone swimmingly for Altria. But I want to own this because it pays a massive dividend. I've used their products. I've smoked in the past, and I want to get my money back. So I figured, just like with Coca-Cola, I've owned the product. I've used the product, and I want to get some money back. So Altria is not what I would consider a long-term position for me. It's a spot to park my money to buy something better. So I'm going to use the cash or the dividend cash flow from Altria to buy something better, as in Apple or maybe Visa, because it pays me, I think it's like 300 and something as of right now. Yeah, my last dividend was $313.60. So that was 320 shares at 98 cents. So it pays a massive dividend. And what I plan on doing is cost down averaging when it makes sense. So as of right now, as of today, it would have been a really good buy. But obviously, I bought before market open. I had the orders in before market open, so I wouldn't have known that Altria was such a screaming buy. But I would prefer to buy Realty Income because I think you have less of an opportunity to buy Realty Income, because a lot of my investing career, it's been at 60, and Altria kind of goes down a lot. I mean, it's a sin stock. Everybody hates this type of company. There's a lot of reasons that it's going to go down, and I don't think that Realty Income has as frequent of a dip as Altria does. I can pretty much buy Altria whenever I want because it's going to go down because people hate this company. So I look at it as more of a short-term fluctuation. I'm not super worried about it. I don't plan on selling it. But as of right now, I'm going to put as much money as I can into Altria when it makes sense, when it's below my average cost. And then that's going to fuel more buys for the second and third months, because the cash flow in my portfolio as of right now is very heavy in the first month, first set of months, 1, 4, 7, 10. Simply because Altria is such a cash cow. Next, Apple, love this company. If I had my choice of purchasing, this would be at the right time if I could time the market, right? This would be my single biggest position. So I want it to be Apple, Visa, and then Coca-Cola by size. Now, that doesn't actually mean that it's going to bring in the most cash flow. It just means that that's how I want the portfolio to go. But as you guys will see as we go through, that doesn't always work out as planned. So I bought the stock and it shot up. So I'll show you guys. It's down $4 right now. Not super worried about it. They did just release that they were no longer pursuing an EV vehicle, which of course I think is great because I think it was a waste. I think it's something that Tesla does better than anybody else. And if you really think that if anybody could do it, I'm sure Apple or maybe like Nvidia or something like that could actually make the chips for the cars. But I think Tesla is just so far ahead that it doesn't make sense for Apple to jump in. But they do have the cash for it. That's the crazy thing is they could just buy businesses. I remember there was a list of businesses that Apple could buy with its cash pile, and it's kind of nuts. It's like 4 or 5 businesses that if it wanted to just gobble up right now, it could. I understand why they're trying to diversify. I know the iPhone is their big cash cow, but they do have the VR headsets as well. They, of course, have multiple businesses, and the reason I like Apple so much is just the ecosystem is so sticky. Once you're in it, you're pretty much in it for life. I used to work at a cell phone store, and I totally know that I saw firsthand. I know how attached people are to their iPhones, and it's because all their personal data is on there. So it makes sense as to why people are so in love with Apple. But today, as of the position size, I only have 1 share. So I bought this a few months ago. Market value is 175.34. My average cost is 132.66, and a small percentage of the portfolio, 0.34% of the portfolio is in Apple. Today, we're down $4. Total, we're up $42. Have a 32.24% return. And the dividend, guys, as you all know, I'm sure, the dividend yield is nothing. It's a 24-cent dividend. As you guys can see, I've owned it for a while, but I did have a share in 2018, and I sold it because I was dumb. So Apple is one of those that I want to be a bigger position in the portfolio, but just given the overall price of it right now, a $4 drop to somebody who bought it at 180 makes sense, but for me at 132, it just doesn't make any sense. So my goal as of right now is I've been paying off debt, and I still plan on paying off my debt as quickly as possible, but I also want to have a pretty sizable cash pile because I want to buy both Apple and Visa and build them up to be 2 of the biggest positions in the portfolio, Apple being the biggest, then Visa. So this is a long-term play for me. I plan on holding Apple as long as their iPhone sales stay intact, which I don't think there's going to be any issue with that due to their economic moat and their customer loyalty and just how well everything is placed together. It's just such a strong ecosystem, and people are so ingrained in Apple as a business. I want it to be the biggest position in the portfolio, and over time it will be. I'm gonna stack up cash, gonna be a patient investor, and just buy what makes sense. So if Apple is too expensive as it is right now, I'm gonna pour money into companies like Coca-Cola and Altria. And guess what? Altria right now could buy almost 2 shares of Coca-Cola sitting at the, Altria could buy 2 shares of Apple. It could buy 2 shares of Coca-Cola as well, but it could almost buy 2 shares of Apple without me having to add any extra capital. That's why I love dividends. So Altria is fueling my Apple buys. And if it doesn't make sense, if Apple isn't at a price where I feel like it's a good value, then I'll buy something else. But that's the main goal for the portfolio is Altria is going to be a catalyst for bringing in more shares of Apple and of Visa. So in that position, my cash is doing the heavy lifting. I just have to tell it how to work. Then next we have AbbVie. So this is actually the biggest position in the portfolio. For a long time it was Altria, because it's grown so much. So this, for me, has been a classic Warren Buffett / Benjamin Graham value play. So I bought this a few years ago, back when they did it they did a takeover. They bought another business. They acquired Allerton. So in that buyout, technically, when they combined, AbbVie was around 88 bucks a share, and my intrinsic value for that point for AbbVie would have been around 95 to 100 bucks. So I knew it was down, and I said, you know what, Allergen, I don't remember the actual price, but let's just say it was worth 50 bucks a share. I'm pretty sure it was worth more than that. Plus the 80, that means together they'll be worth 130. I'm like, well, if my intrinsic value for AbbVie is, 100 bucks, let's just say, and I think Allergen with Botox over the next 5 years can go up to 70 or 80 bucks a share, then together they'd be worth around, I said about 150 to 170. Well, right now, AbbVie's at 176. So, and that's with a little bit of a downturn as well. So this is just a classic Benjamin Graham value play for me. I saw that saw the opportunity, an arbitrage opportunity, which just means some people bought Allergen and some people bought AbbVie. And a lot of people, like what Buffett did with the Microsoft deal, he bought Activision Blizzard because Microsoft is going to acquire them, and then eventually that turned into Microsoft stock. So once it would have sold, once it would have turned into Microsoft stock, he could have sold or he could have held it. So arbitrage is one of those classic Buffett tactics that I honestly don't see done a lot on YouTube. I have not done a lot of it myself, but AbbVie is one of those shining examples for me in my portfolio that it makes sense. There's been a couple. Kroger just tried to buy Albertsons, and I believe that's going through. Of course, everybody knew about the Activision Blizzard Microsoft deal, which I did think about going into at like 80 when they were going to buy 95 per share. So there's been a couple of opportunities, but I just haven't had the capital. So if I see one and I jump into it, I'll tell you guys. But this is the classic Benjamin Graham Buffett style type stock that, this type of strategy is what Buffett used to do before he ran Berkshire. He doesn't do it as much now because he has so much capital that he can't really make these quote unquote smaller moves because he's got so much cash that he could just buy AbbVie out. He could just buy the entire company. So in the grand scheme of Berkshire and how it's built, a deal like this wouldn't make a huge move for Berkshire. So right now I have 95 shares. So I originally bought, I think it was 80, and over time I bought like 15 more shares with my cash and dividends. But right now we're sitting at $16,800, $95.19 is our average cost. 32% of the portfolio, 32.5% of the portfolio is an AbbVie. Today we're down $196 or 1.16%. Total return, we are up $7,756 and it was 96 cents, but it'll fluctuate due to the market being open. But the important part, our overall return is about 85.5%. So as you guys can see, this type of investing can be very lucrative if you're patient enough to sit and let it compound for you. When I originally bought AbbVie, the dividend was like $1.07, I believe, and I just got paid a dividend of $1.55. So I bought this around 2018. So I've held it for 18, 19, 20, 21, 22, 23, so about 5 years, probably almost 6 years now. And the dividend was $1.07 at 80 shares. And I can even go back and show you guys, because I don't think I've ever sold a share of dividends, of AbbVie. But I'll even show you guys what it started out as. So when I originally bought the stock in 2019, the dividend was $1.07, and I owned 58 shares. That was just how much cash I had sitting on the sidelines, was 58. And then as you guys can see, the dividend kind of grew, and I bought a couple more shares. I have 60 there now at 78. I have the same 60, but it's at $1.30. So see what I mean? When you buy and hold, it makes a lot of sense because the dividend keeps growing. Now I bought a couple more shares. I have $1.30. Now if we go up to, say $1.40, now I have 95 shares, so I bought a few more at $1.48. And now I'm sitting here at February 15th of 2023 at $147.25. So my original, 58 shares, I bought more when it made sense at $1.07. Now I have 95 shares paying me $1.55, $147 every single quarter, all off of that arbitrage deal. So not only has the stock price doubled, right? The stock price is, more than doubled, but let's just say doubled. Stock price has doubled. The dividend has also grown exponentially, and that's what I'm after, right? I don't even mind the stock price because I don't want to sell it. That's my big issue. At some of the opportunities that I've seen, I've wanted to jump in. Like there was Facebook at 80, and I literally talked to my spouse at that time, and my roommate too, and I was like, "Oh, Facebook's at 88. Like I know this company intrinsically worth is around. I think it's around 250 to 300. I think it's around $300 a share. It's at $485, around the $480 mark right now. So I could have 4x'd my money because originally I had T. Rowe Price. Well, I had VFC Corp, and that didn't go well. So I switched it back into T. Rowe Price because I was stupid. And then I switched that into Tyson Foods. Guys, I'm not perfect. I make moves sometimes. But Tyson Foods is not a company I wanted to own long term. And neither was VFC. They actually cut their dividend. I made money on the trade, but that's not the way I usually invest. And I got bit for changing my strategy. So what I did instead, I put that money into T. Rowe Price. Now, once I saw that Facebook was at 80, I literally said to two different people, even my mom, I said I need to buy Facebook at 88, and I didn't do it. So that would have made the portfolio worth probably about $100,000. So not every opportunity is a good opportunity. And as investors, over time we learn. Like Facebook would have been my deal of a lifetime. Like I own like 80 shares of GameStop. Like a year before it blew up and went to 300, I bought it at $15 a share. I would have had over $120,000 of value in my portfolio if I would have just held on to those GameStop shares. But I thought it was a failing business, so I let go of it. So not all the moves that you make are going to be successful. And I want to do videos again because you guys deserve to see all of that. And it holds me accountable too. I feel like I'm less likely to sell if I have 600 people on YouTube telling me I'm an idiot, don't sell Tyson Foods at 55 or whatever. But not all of your moves are going to be great, right? And that's the beauty of investing is, sometimes you make the wrong call. But anyway, sorry, didn't mean to go on a rant there, guys. But overall, the return's 85% because of that arbitrage deal. And if I see another one and I jump into it, I'll let you guys know. Next, we have T. Rowe Price. I was talking about this one a little bit before because I've switched in and out a little bit. But I own 100 shares, $11,700 worth of market value. Average cost is right around $110 a share, so I'm up a little bit. 23% of the portfolio is in T. Rowe Price. Today I'm up around $400. Total, I'm up around $770, around 7%. So guys, I love T. Rowe Price. I looked at it for a long, long time. And the 52-week high is 126. But if you look a little bit further back, before the whole COVID crash thing, because during COVID it was in the 90s, and then it got all the way up to 215. So if you look back a little bit, this still has a lot of room to grow because the 52-week high is 126. But if you look back to like 2 years ago, it got all the way up to 220. So even though it looks like it doesn't have much room to run sitting here at 117, the 52-week high is only like $10 more. If you look at it this way, at what it truly could be worth, given all the economic issues, because the thing is, T. Rowe Price is an investment company, which means when the stock market's doing good, it does good. It collects more fees, it puts more assets under management, and obviously it probably gains more customers. But when the market's down, like as you guys could see, it was way up and it dropped. So this company's been on a little bit of a wild ride, but the earnings are consistent. The dividend growth is consistent. They're very good at deploying their capital, and I love their business model. So I'm going to be holding T. Rowe Price long term. I'm not going to be buying any of these prices. But even though it only says it has a $10 upside, I know, being a long-term investor, and I've held this company for quite a while, I know that it could go up to 220. So I'm not going to sell it at 120 because I have a $100 upside per share plus what I have now. So I have essentially $10,000, right, of value sitting here that's locked into the stock that I just have to sit and wait for. So I'm happy to sit and wait, and as well as the dividend grows as well. The dividend, I'll go through. Sorry, I'll check it out. I'll show you guys real quick. So originally the dividend when I bought it, I'll go show all, because I have bought. Remember I told you I bought and sold a little bit on this company, so it's not going to be a perfect line. See, so the dividend was 108 in 2022. So it was, I made $108. So I bought and sold it a little bit. Now the T. Rowe dividend for 100 shares, $1.22. And now I only had 98 shares the last time. So I sold out of another company and bought back in. So the last time I paid a dividend, I only had 98 shares. So now I'm just going to sit and hold, guys. That's really what I'm going to do. So this has the opportunity to be another AbbVie. So if you look at the 52-week high of T. Rowe Price right now, it doesn't look like I have much upside, which is totally fine. But if you're a long-term investor and you believe in the business, and you know that it was at 220 in the past 2 years, I have a $100 upside per share, which means I have $10,000 sitting there. So my $11,000 position eventually could turn into like a $21,000 position plus dividends. So I'm happy to hold it. So guys, that overall is the portfolio. I'm pretty happy with it. As you guys know, we do have some duds, some stocks that aren't performing very well right now, being Altria and Realty Income, but that's totally fine. I think that the gains in AbbVie and T Rowe eventually will outshine those. And I mean, Altria is doing what it's supposed to do for me. It's going down so I can buy more, and that cash flow is going to buy me more Apple when it makes sense. So overall, guys, I'm happy with the portfolio. Let me know what you guys have been buying, selling. I missed you guys. I shouldn't have taken an 11-month break. I'm sorry about that, but I plan on doing this every single day. It adds a little bit of happiness to my life. It does. I missed it. So I just want to say thank you guys so much for watching. Thank you for your patience. And it's that Dividend guy signing off. I'll see you tomorrow. Take care, guys.